Hello everyone, welcome to Oliveboard. I hope you all are fine and doing well. So in today's class we are going to discuss some questions of module B. A very good morning to everyone. So let's start with the class. Here we will see all the questions. So first question is in front of you. What is the main difference between risk and uncertainty? See, if we talk about this risk, what is risk? Risk is basically measurable. We know that this type of situation may occur in the future. Okay, but uncertainty is the a certain type of situation which we don't know, banks don't know, businesses don't know that why this type of situation will be there and what are the consequences of this situation. So we can say that uncertainty cannot be measured. So risk can be measured, but uncertainty cannot. So, in which of the following situation is there is a least risk? In which of the following situation there is a least risk? Which trading share with fluctuating pricing, running a business in a fluctuating market, investing a bonds at in RBI at a fixed rate, buying and selling the goods internationally. Now it is clear. Now it is clear. Now it is clear. Okay, just give me a minute. Now please confirm that is that fine now, because I changed the mic option here. So I hope that now it is fine. So there is a question, in which of the following situation there is the least risk? See, if we are talking about the RBI bonds, these RBI bonds offer the fixed returns and no variation in the cash flow. Because of that, these bonds become zero risk investment. So other options involve variable outcomes, but this RBI bonds basically we can say very least risk are there. So investing in RBI bonds at a fixed rate is the correct answer here. Okay. Fixed rate is the correct answer. Thank you. Next question. Why is RAROC considered a better measure of performance than ROA or ROE? Why is RAROC considered a better measure of performance than ROA or ROE? Because ROA, return on assets and return on equity, this measure return but ignore risk. They measure the return but they ignore the risk. RAROC improved this by accounting for the amount of risk taken to earn those returns. This makes it more accurate and fair metric for comparing the performance across different business units or investments with different risk level. So here we can say that the because it accounts for the amount of risk taken to earn return, that is the correct answer here. So a business with the high variability in the net cash flows will require see, high variability in cash flows means high risk is there. And just to survive the potential losses, such type of business must hold more capital as their buffer. This type of capital help absorbing shocks and also avoiding the financial failure. So higher capital is essential in the high risk businesses. So the option B is correct here. More capital due to higher risk of loss. Why risk management is important for the business continuity? Because obviously it controls the losses within the capital capacity. Means like risk management committee is there which always play a oversight strategic role, not operational. It defines policies, review the limits and ensures the risk models used are effective. It does not deal with individual loan or HR activities. So the correct answer is here option C. Next question. What can happen if risk is not properly estimated in pricing a product? So, see what can happen here. The ELCO basically focuses on the market and the liquidity risk, which ensures the bank has enough funds funds and earns the good net interest margin. So it suggests rates like MCLR and aligning the funding and lending strategies. While other committees are there, they are focused on the credit or operations. So here the correct answer is option C, that they may lead to loss of business or reduced profits. What is the primary responsibility of the risk management committee at the board level? Board of directors have a one responsibility, that is the primary responsibility, setting the guidelines, limits, as well as ensuring that there is a robustness of model. So that option is correct, setting guidelines, limits, and ensuring that there is a robustness of the models. So which committee is responsible for managing the liquidity and recommending lending rates like MCLR and RLLR? Answer is here, Operational Risk Management Committee. Operational Risk Management Committee, why? Because we know that operational risk means when there is a problem related to uh, any type of fraud error, internal error, external error, which is not in the control of the banks, like external errors. So here operational risk management committee is responsible for managing liquidity as well as recommending the lending rates like MCLR or RRLR. Which of the following is an example of basis risk in banking transactions? What is basis risk here? Obviously, basis risk means when interest rate used to price the asset and liability difference. In that case, the loan is linked to the MCLR while the deposit has a fixed rate. If the MCLR decreases, so interest earned may drop, but interest paid remains the same, which cause the potential losses. So here the correct answer is obviously option C, that is loan linked is to MCLR while deposit interest is fixed. What is the purpose of downside potential as a risk management tool? Downside potential. Downside potential means measuring how bad things can get, especially in the extreme situations, and it is commonly used in stress testing and tools like value at risk, and it helps the banks to decide how much capital they need to survive in the case of worst case scenarios. So here we can say that correct option is option D, to assess the potential loss in severe adverse conditions. Now, which of the following best describes the limitation of the sensitivity analysis in financial risk management, financial risk measurement? See, if we are talking about the limitation here, we know that sensitivity analysis considers the effect of one parameter,
at a time, like interest rate or a stock price. It ignores the fact that multiple market parameters may shift simultaneously, which is a limitation in the real world market. So, the correct option is option C. It assumes only one market factor changes at a time. A bank wants to estimate the monthly volatility of a stock using its daily volatility. So, we know that there is a formula for the calculation of volatility. Option C is correct, where daily volatility multiplied by under root of number of days. So here is a monthly volatility, that's why 30 days is there. So why is downside potential considered a better risk measure compared to simple volatility in the financial risk management? See, if we're talking about the volatility here, volatility measures all the deviations. We know that volatility measures all the deviations at up to down from the average, but in risk management what really matters, that is the chance of loss, not the chance of gain. Here downside potential zeros is on adverse outcomes only, which make it more meaningful for decision banking in the India. So it is the foundation for measure like value at risk, which estimate worst case loss scenarios within a confidence level. So the correct answer is option B. It focuses only on the adverse deviations. So in risk based pricing, which of the following is not a direct cost that banks consider while pricing the loans? See, we know that when a borrower credit score influences the loan approval and interest rate level, so it is not a direct cost like operating expense, default probability or capital cost. Risk based pricing focuses on the measurable financial cost to the bank, how much it costs to raise fund, covers the losses, maintains the capital and make a profit. So credit score is a risk indicator, not a cost. So the option C is correct here. Which of the following best describes the primary objective of a bank risk monitoring and control function? Primary function that describes the primary objective of a bank risk management and the controlling system. See, the goal of risk monitoring is not to eliminate the risk entirely. Basically, that is the unrealistic in banking, that eliminate all the risk. Instead, banks aim to balance risk and reward, They seek to maximize returns, which is adjusted for the risk taken, all while ensuring that they do not breach the capital limitations. This thing is captured by the concept of RAROC, risk adjusted return on capital, which is a core idea in the modern banking risk management. So the correct option is here option D. Why it is important for risk management function to be independent from the bank operational departments? Obviously, the risk management function should be independent from the bank's operational department. Why? Just to prevent conflict of interest in risk taking businesses. So option C is correct here. Why is primary trade-off involved when a business adopts these risk mitigation strategies such as contracts or hedging? So if we say the correct answer here, risk mitigation strategies are there like contract, insurance, hedging aim to reduce the uncertainties. But in doing so, the businesses also lock in prices and limits flexibility, which meaning they lose out on supernormal profit if the condition turns favorable. So stability improves, but here upside potential reduces. That is the real trade-off in the risk mitigation. So the correct answer is option B, that reduce the risk but limit the upside potential. So which of the following is not a component of COSO enterprise risk management framework? There are 8 components are there. So which of the following is not a component? See, 8 components, they focus on the risk governance and as well as the about governance as well as control, objective setting, risk performance, monitoring, internal control, internal environment. These are the elements of COSO, but market strategy is important for the business. That is important for the business, but we can't say that this is the component of the risk management framework. It is operational or growth initiative, not the part of ERM risk control infrastructure. So the correct answer is here option C, that is market strategy. So why is operational risk considered one of the most critical risk in the banking? Because it can lead to the severe losses, reputational damage, and the regulatory issues. So the correct answer is option C. What is the common goal across all the banking business lines, whether it's a trading, retail, or asset management? Achieving the high profits without the capital allocations. Okay, basically the main aim is just to enhance the risk adjusted expected return. So they will get the returns after adjusting all the returns, and we know that banks operating different types of business units, Each is with own complexities. There are own complexities are there. Despite the difference, the common objective is just to generate the returns that are like compensate with the risk and the capital employed. This is basically enhancing risk adjusted return, which, which measures using the RAROC, and it ensures sustainable growth while complying with capital adequacy and risk tolerance. Next question. Which of the following best explains the banking book is not exposed to the market risk? See, if we talk about the banking book, so here we know that banking book means which consist long-term assets and liabilities like loans and deposits that are intended to be held until the maturity. These are accounted using the accrual system, not daily market prices. They are not exposed to fluctuations in the market value. Unlike the trading book, market risk is not applicable to the banking book. So the correct answer is here option B, because it holds asset until the maturity and does not use the mark to market accounting. So what is the major difference between the trading book and banking book in terms of accounting and the risk exposure? See, major difference. Trading book, banking book includes long-term assets and liabilities, while these trading book includes assets that are actively traded in the market. So they are marked to market daily, which reflects the current market value. This makes them highly sensitive to the market price movements, which exposing them to the market risk. So the banking book on the other hand uses the accrual accounting and holds assets to maturity, hence it does not face market risk directly. So the correct answer is here option C, where trading book uses mark to market accounting and it is exposed to the market risk. So what which describes an off balance sheet exposure and the associated risk to a bank. Uh, if we talk about the off balance sheet exposure, these are the contingent liabilities like guarantees, letter of credit, and derivative contracts. But they do not involve immediate cash outflow when they are issued. However, if the triggering event occurs, the bank must fulfill the obligation, which making it a real financial outflow. This exposes the bank to liquidity risk, credit risk, and more, despite the exposure not being initially recorded in the financial statement. So we can say that here the correct option is a potential obligation that does not appear on the balance sheet initially but may result in a future cash outflow. So which of the following situation best demonstrate basis risk in interest rate risk management? See, this basis risk occurs when the interest rates of assets and liabilities are based on the different benchmarks, which may move differently over the time. But the loan is floating and that can be changed every 2 months. So while the deposit is fixed for 2 years, so if the repo rate drops, the loan earn less interest, but the deposit cost stays high, which narrowing the net interest margin. This mismatch in rate movement magnitude is classic basis risk. So here we can say that option C is correct, where a bank funds a 2-year floating rate loan with a 2-year fixed deposit. Which of the best following illustrate basis risk in interest rate risk? Basis risk in the interest rate risk. Let me tell you about this. Basis risk arises when the interest rates of assets and liabilities are linked to the different benchmark. Told you that. Like different benchmark, like 91 days, 364 days, and both arises but not by the same amount, which leads to mismatch in the net interest income. So the if we see the options here, a bank uses a floating rate deposit which is linked to the 91 day to fund an asset which is linked to the 364 days T-bill. So that is the best example of basis risk which illustrate in the interest rate risk. Operational risk, which of the following is not operational risk? Strategic risk. Because strategic risk means when the policy is not up to date, that like policy is not there good, which makes loss for the organization. So that is not included under the operational risk, because operational risk includes the error, the human error from the software or any technology, and some type of external errors which are not in the control of the bank. So strategic risk is one of the best example which illustrates that this is not the example of operational risk. So bank lends heavily uh, company which is dependent on the fossil fuels. Now new government policies that promotes the electric energy and then imposes carbon taxes. So which type of climate risk is that? See, climate risk has two types, right? First one is the physical risk. Second one is the transition risk. Physical risk means which is basically like natural disaster type of situation. But this transition risk means when the government shifting to the uh, green carbon economy, that we can say that is the transition risk. So here government policies promotes to the electric energy and also imposes the carbon taxes. So the answer is here transition risk. What is the primary reason for regulation banks and financial institutions? Just a minute. What is the right answer? What is the primary reason here for regulating the bank and financial institution? See, primary reason is there, protect the depositors and ensures the financial system stability. That is the correct answer here. Because obviously banks need to protect their depositors and they want to ensure the financial system in a stable manner. Which of the following explains the systemic risk in the banking? Systemic risk means when the one bank failure causes widespread disruption across the financial system. When one bank failure causes the problem to the other financial system, that is the cause of systemic risk. So option C is correct here. Why was the Basel Committee on Banking Supervision established in 1974? Um, Here they are talking about the BCBS. BCBS was born out of Herstate's incident, where time zone mismatch caused serious settlement risk. The failure created the global losses and exposed the need of unified international regulations, uh, and also unified type of rules. The BCBS under the BIS to standardize the agreement and the regulations, and they reduces the cross border banking risk, which is here, which means the option C is correct, where to address the risk associated with the global banking, which following the failure of banking, Bankos Herstate. Bankos Herstate is the perfect example of the settlement risk. Just because of settlement risk, situation, this type of risk is arised at a big level, at a very big crisis we can say. So after that, this Basel committee formed and they now making the uniform rules for every bank, so that type of situation will not occur again. So the correct answer is option C. So what is hard state risk and how it lead to global banking reforms? Hard state risk. Hard state risk, we can say, refers to the settlement risk that arises due to the time differences in the international currency transactions. Bangkok's hard state was shut down by the regulators because it could deliver US dollars in a cross-border transaction. This triggered the formation of BCBS, which aimed at preventing such systemic risk through better supervision and global coordination. So the correct answer is option B. The risk that the bank might fail before completing a cross-border currency transaction, which cause counterparties to lose the money. So the correct option is option B. Just read the next question and just allow me a 1 minute. What was the primary objective of Basel I Accord, which is introduced in 1998? See, Basel, that is they are talking about the Basel I. Basel one is basically that is telling about uh, the just to establish minimum capital requirements. Why? Because if the bank has minimum level of capital, so uh, they can like deal in the worst situations. They can handle the worst situation with that capital. So establishing a minimum capital requirement which is linked to the credit risk of bank is the correct answer here. That is the primary objective of Basel I. So what is the amendment of market risk which has introduced the Basel I in 1996? See, market risk amendment introduced the use of value at risk model for calculating the capital which is required for the market risk. So it introduced the use of value at risk models for calculating capital whatever required for the market risk also. So in 1996, credit risk are already there, but now market risk are also added. So which among the following attribute reflects the pivotal transformation in Basel's second credit risk methodology, uh, where Basel I static risk weight regime is there? See, here integration of the internal credit assessment mechanism via IRP approaches is the correct answer here. Means Basel II credit risk methodology is just to uh, create, so like three pillars are there: minimum capital requirement, second one is supervisory review process, third one is market discipline. So Basel implementation wants to follow these types of these three pillars. Why? Just to make sure that everything is okay. So they makes different types of approaches. They uses different types of approaches just for betterment. So that's why option C is correct. So under the Basel II Accord supervisory framework, what enforcement mechanism undergirds a regulator uh, prerogative to impose different capital thresholds on the institutions with deficient risk governance framework? See, this counter cyclical buffer. What is counter cyclical buffer? Basically, that is a macroprudential tool under the Basel III, which aimed at countering the pro-cyclicity of credit markets. During the credit booms, market tend to overlend and risk taking increases. So that counter cyclical capital buffer requires banks to build the extra capital. This buffer can be released during the economic downturns, which allowing the banks to continue lending even in stress. It helps in smoothing the credit supply, reducing the likelihood of a severe bust or severe situation. So we can say that option B is correct dealing with that situation, that is promote corrective actions, because obviously corrective action must be taken by the banks to improve everything. So the B option is correct here. Which of the following best encapsulates the rationale behind the introduction of a leverage ratio under the Basel III framework? Which among the following best encapsulates? See, here basically RBI mandates the capital adequacy compliance at different levels. Okay, and if we say about the levels, these levels are solo level as well as the consolidated level. So it also enforce non-risk weighted backstop that curve excessive on off balance sheet leverage. Macroprudential objectives served by counter cyclical buffer introduced under the Basel III. CCB is a macroprudential safeguard which is designed to force the banks to accumulate the surplus capital during the good times so they can absorb shocks during the downturns without needing government bailout. It also restricts the dividend payouts when capital falls below the buffer threshold, protecting the bank's core capital base. So, we can say the correct answer is option B, which moderate the amplification of the foreign systemic vulnerabilities during credit expansion cycles. So the correct answer is option B here. So, which of the following correctly reflects the dual level capacity capital adequacy compliance framework which is mandated by the RBI under the Basel third implementation in the India? See, I told you about the level, that is two levels are there, solo level, group level, which is consolidated level also. So here we can say that the correct answer is compliance must be ensured both at the consolidated group level and stand alone solo level. Okay, so under pillar 2, the Basel framework, the internal capital adequacy assessment process primarily aims to see. Pillar 2 enhances the capital adequacy framework by focusing on a bank specific risk which is not fully captured under the pillar 1. ICAP require banks to identify, measure, manage and hold the capital against all the material risk which includes interest rate risk is the banking book, credit concentration, liquidity and operational risk. It is a customized approach, not just a regulatory formality. So banks have to review their own capital levels and engage with the RBI if there are shortfalls. So we can say that the correct answer is that which helps the banks in assessing their internal capital needs which is based on full risk exposure. So which of the following best distinguishes market risk from market liquidity risk in a bank trading book? See, market risk is related to the price volatility. Market liquidity risk is about the inability to sell the assets without the price impact. Obviously, market risk when there is a fluctuation in the price, but market liquidity risk is all about the inability to sell the assets without the price impact. So, which of the following best explains the rationale behind the middle office being functionally independent from the treasury in the context of market risk management? See, to ensure unbiased, autonomous risk measurement and validation, mitigating the potential conflict of interest, we can say that is explaining the rationale behind the middle office because they have to do the measurement, they have to check the validation, they have to make the strategies to reduce the risk and conflict also. So there is a scenario where a bond portfolio demonstrates a basis point value of 85,000. So what does figure denote in technical market risk measurement terms? See, basis point value quantifies the absolute change in a portfolio value. For a 1 basis point, that is 0.01% movement in interest rate, a basis point value of 85,000 means that if the interest rate changes by 0.01%, the bond portfolio value will change by the 85,000. That bond point value is a linear sensitivity measure which is used for the interest rate risk in a fixed income portfolio. unlike duration, it is expressed in currency units and it is essential for a market at risk modeling. Okay, let's do this question. Which among the following best tells about the there is some issue. Okay. Within the governance framework of bank credit risk management structure, which entity is primarily entrusted by the policy formation concerning risk concentration, asset classification thresholds, and financial convents benchmark? See, here CRMC is completely responsible for that. So the correct answer is Credit Risk Management Committee. Just let's see the last question for today. Which of the following explains the rating migration in the context of bank internal credit rating system? Credit ratings, these are the probabilistic models, not the guarantee. They only make the assumptions. So while a C rated borrower might survive and an A rated one might default, so the law of large number ensures that on average C rated accounts will default than A rated ones. If 100 C rated loans default at 10% and 100 A rated loans at 1%, this pattern is consistent. This explains the thing that the rating is not a crystal thing, but a statistical tool is there to estimate the default likelihood across borrower groups and helping the bank designing portfolios and pricing models accurately. So the correct answer is here option B. It signifies the movement of a borrower credit rating to a different risk grade over the time under the same rating model. So see, these we have seen here about 45 questions. See, uh, I will upload some more questions with this PDF, so you with the answers, so you can check and practice. If you feel anywhere any problem, you can tell me. So that is it for my side for today. I hope that this class is helpful for you. I try to make the questions in a different way. So if there is any problem, you can tell me so I can help you. So that is it for today. Let's meet tomorrow for our module C. Till then, take care and have a good day all.